Germany sells 1 million cars to America every year. America sells Germany software, movies, and debt. One of these countries is winning, the other one thinks it is. In 2024, the United States ran a trade deficit of over $700 billion. That's not a typo. 700 billion more going out than coming in. And yet, the dollar is still the strongest currency on the planet. The stock market keeps hitting record highs, and Washington keeps spending like there's no tomorrow. Meanwhile, China holds over $3 trillion in foreign reserves. Japan holds $1.3 trillion. They're sitting on mountains of American IOUs, and they can't spend them. Something here doesn't add up, and the thing that doesn't add up is quietly rewiring the global order. For the last 50 years, we've been told trade deficits are bad, that when you buy more than you sell, you're losing, that countries like China are eating America's lunch because they make everything and America makes nothing. But if that's true, why is the country with the biggest trade deficit also the richest country in human history? Why does everyone still want dollars? And why are the so-called winners so nervous? The answer is buried in something most people never think about. Something called the capital account. And once you understand how it works, the entire story of global power starts to look completely different. Because trade isn't just about goods anymore, it's about control. And the countries selling us stuff aren't actually in the driver's seat, they just think they are. Let's start with the obvious part. A trade deficit means you import more than you export. Simple enough. America buys electronics from China, cars from Germany, oil from the Middle East. In return, it sends dollars. Now, here's what they don't teach you in high school economics. Those dollars don't just disappear, they have to go somewhere. And when foreign countries accumulate dollars, they face a choice. They can spend them on American goods, or they can invest them back into America. Guess which one they pick? China doesn't want Nebraska soybeans. Japan doesn't need another Boeing jet. What they want is a safe place to park trillions of dollars. So they buy U.S. Treasury bonds, they buy real estate in Manhattan, they invest in American companies, they fund American infrastructure. This is the capital account. For every dollar that flows out in the trade account, roughly $1 flows back in through investments. The balance sheet zeroes out, but the power dynamic doesn't. Because when you owe someone money, you're vulnerable. But when someone has no choice but to lend you money, you're in control. Here's the part that sounds absurd until you sit with it. The U.S. trade deficit isn't a bug, it's a feature. Every time America runs a deficit, it's essentially saying to the world, send us your products and we'll send you paper, or more accurately, digital entries in a database, dollars, which we can print. And the world says yes, because what else are they going to do? If China stops selling to America, their factories shut down, their unemployment spikes, social unrest follows. If Germany stops exporting, their entire economy craters. These countries have built their growth models around selling to the American consumer. They need the deficit more than America does. And here's the kicker. Because they need to sell, they end up financing America's consumption. China buys U.S. Treasury bonds to keep the yuan cheap, which makes their exports attractive, which keeps Americans buying, which means more Treasury bonds. It's a loop, and the U.S. is at the center of it. Meanwhile, America gets cheap goods, low interest rates, and the ability to borrow almost infinitely. The trade deficit isn't a weakness, it's leverage. Now, this is where the story is sold to you in two very different ways. Version 1, America is in decline. It's been hollowed out by globalization. The factories are gone. The middle class is struggling. China is going to own the 21st century because they make everything and we make nothing. Version 2, America runs the table. The dollar is king. The trade deficit is a sign of strength, not weakness. Everyone wants in on the American market, and we're essentially taxing the world by paying them in currency we control. The truth is somewhere in the middle, but closer to version 2 than most people realize. Yes, American manufacturing declined. Yes, there are real costs to communities that lost jobs, but the aggregate wealth of the United States has exploded. The S&P 500 has quintupled since 2009. American tech companies dominate the world, and the dollar's share of global reserves has barely budged in 30 years. China's export machine made it rich, but it also made it dependent on American consumers, dependent on the dollar, dependent on a global system it didn't build and doesn't fully control. So if the trade deficit is actually a form of power, why does it feel so fragile? Because the whole thing runs on trust. Trust that the dollar will hold value, trust that America won't default, trust that the global system will stay stable. And that trust is being tested. China's trying to internationalize the yuan. They've set up currency swap lines, launched a digital yuan, pushed for oil trades in renminbi. It hasn't worked. 70% of global trade is still in dollars, but they're trying. Europe's stuck in the middle. Germany's entire economy depends on exports, but it's slowly realizing that tying your fate to someone else's consumer base is a vulnerability, especially when that consumer base can just print money. And then there's the debt. The U.S. national debt is now $36 trillion. Interest payments alone are over $1 trillion a year. At some point, the math stops mathing. At some point, foreign investors start asking if Treasury bonds are really risk-free. The trade deficit works as long as everyone plays along, as long as China keeps buying bonds, as long as the global system runs on dollars, as long as no one builds a viable alternative. But alternatives are being built, slowly, quietly, and the countries running surpluses are realizing that financing America's consumption forever might not be the winning strategy they thought it was. Here's the thing that keeps economists up at night. The current system allows the U.S. to run massive deficits without immediate consequences, but it creates imbalances that build over time. When dollars flood into foreign economies, they distort everything: asset bubbles, currency manipulation, inequality. Countries like China end up with massive reserves they can't actually use. They're locked into the system. And on the US side, cheap imports sound great until you realize entire industries have been wiped out. The political backlash is real. The social costs are real. The fact that it works on paper doesn't mean it works for everyone. There's also the nuclear option. What happens if a country just stops playing? What if China dumps its treasury holdings? What if oil producers start pricing in yuan or euros? The answer is probably chaos, but also probably not sustainable chaos, because the alternatives aren't ready. The euro is a mess, the yuan isn't trusted, gold can't scale, and crypto is still a speculative toy. For now, the dollar wins by default, but default isn't the same as inevitable. So here's where we are. Trade imbalances aren't what they seem. The countries with surpluses aren't winners, they're lenders, and the country with the deficit isn't losing, it's borrowing at gunpoint. But that only works as long as the gun is loaded, as long as the world believes in the dollar, as long as alternatives stay broken. The power isn't in the trade flows, it's in who controls the currency. Who sets the rules? Who gets to print money when things go wrong? Right now, that's still the United States, but power never stays in one place forever, and the countries holding trillions in dollar reserves are starting to realize they're not creditors, they're hostages. And the question nobody wants to ask is what happens when they figure that out?